And despite recent rate cuts by Korea's central bank, which made it easier for firms to cover their costs, a large number of major companies have been unable to pay off their interest debts. Our Kwon Soa tells us why these companies are still struggling.
1 out of 4 of Korea's biggest companies are having a hard time covering their interest debts with their earnings. According to conglomerate tracking market researcher Chaebul.com, 37 companies that made annual sales of more than $910 million last year recorded an interest coverage ratio of below 1. A ratio above 1 means the company makes more than it has to pay in interest. Below 1 means it's unable to cover its debts. It may seem ironic that the number of firms in the below 1 category increased by nearly 2 percentage points from 2013, despite the Bank of Korea's 2 key interest rate cuts last year, leading to cheaper borrowing costs.
The operating profits of large firms are shrinking at a bigger rate than the interest rate cut has shrunk interest payment burdens. This is especially so since the economy's growth rate fell to around 3% since 2011.
Data shows the shipbuilding, steel, and petrochemical industries have struggled the most to pay off their interest debts. For instance, Hyundai Heavy Industries, the world's largest shipbuilder, posted an operating loss of $1.7 billion last year.
The sectors that have been most affected are those highly dependent on exports. Since Korea is especially dependent on exports to China, an earnings slump is expected to continue following China's slowing economy.
That's why, with no immediate signs of improving external factors, analysts forecast that this year will continue to be challenging. Although the central bank's rate cuts were not enough to help large companies repay their interest debts, experts say that in order to enhance investment conditions, another cut may be inevitable. Kwon Soa, Arirang News.